Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value entertainment out of these videos, I'll ask you to hit thumbs up and subscribe. Questions, comments, put those below. As mentioned last week, I'm just here in Vegas for the Real Vision Crypto Conference. So I'll briefly touch on that, but more or less want to bring you sort of an update for the week that was. With some of my thoughts here. We got a few updates. First and foremost, the Bank of Canada coming out this week, opting to hold rates. I think there was like a 20% odd of a rate hike. And obviously they kept rates where they were. More interesting to see the commentary that's coming out of that. The Bank of Canada, despite markets pricing in and trying to force the Bank of Canada to move on rate hikes, is that they continue to push back. So they pushed back again, reiterating that they won't be raising interest rates until the mid quarters, they're calling them, of 2022. So keep that in mind here, because again, I think markets are again trying to push the Bank of Canada in January to sort of have liftoff on your first rate hike. But what the Bank of Canada has basically been doing is using this Omicron variant, as well as mentioning the BC floods as sort of a excuse not to raise interest rates. And again, like I said, when you have the amount of debt load in the world, particularly in Canada, you have to kind of continue to look for more and more excuses. And I suspect that there's going to be more excuses here moving forward. It could just be, housing starts to slow down or what have you, that they'll use that to justify. But I also wanted to touch on a little thing here, because I'll post it in the next couple days once it's available. But I was actually just invited to the House of Commons. I was sort of a witness, so to speak, for the finance committee for the federal government. So I was 2-hour long Zoom session with the finance committee, sort of getting my thoughts. Basically, what they're trying to do is they're trying to ram through a new $7 billion deficit spending bill in order for sort of COVID relief. And so I went on there to sort of provide my thoughts, on that, but more so from the real estate angle of touching on, hey, you're going to spend this money. There's obviously ramifications, there's knock-on effects from that, which I think obviously we're seeing in the housing market. But that I was actually invited onto that sort of panel in response to this Pierre Poilievre video, which I'm going to loop in right now.
How is the government paying the $7 billion bill associated with this proposal?
That question is directed to who, Mr. Poilievre?
Anyone who wants to answer it. If they have anyone over there that is concerned about where the money comes from, that person could speak up.
Maybe you could choose one of the witnesses.
I don't know who on their side is responsible for this, but clearly they're getting the money from somewhere, so they must know where. Anyone here from Finance Canada?
I see Mr. Baylor.
Mr. Chair, I can provide a high-level response, but I'm afraid I won't be able to answer directly the honourable member's question, because we're here to discuss it. And what I can say with regards to the cost of the measures in terms of Part 1, the three first programs that I mentioned, the hospitality, the tourism and hospitality recovery program, Part Businesses Recovery Program, and the local lockdown program have a cost of $3.2 billion.
And where's sorry, Mr. Baylor, where's the money coming from?
Well, Mr. Chair, that is within the government's broader macroeconomic framework, and I'm not I can't speak to that.
So you don't have anyone. It's just that we're being asked to vote in favor of another $7 billion of spending. The obvious question is, where's it coming from?
can discuss the contents of the bill, and I appreciate the question, but I can't answer that question.
Well, somebody's paying for it. Who is it? Did the Tooth Fairy? No answer.
We're here respectfully to answer questions to C2 as we study.
Right. C2 has a $7 billion bill. That's the price tag. Right. That's what I'm asking about. Where's the $7 billion coming from? There's a lot of people are willing to talk about how they're spending the money, but no one wants to talk about where it comes from. How many witnesses do we have here? We have the number? Mr. Chair?
10? Is it 10?
10 witnesses? 10 witnesses to tell us about how to spend money, but not a single one to tell us where the money comes from. Anyone, Mr. Chair, can you help us?
Mr. Polyev, the floor is yours to ask your questions.
Well, I've asked the same question 5 or 6 times. No one seems to be able to answer it. I'm just worried that the answer is not one my constituents are going to want to hear. Because right now, I have 30-year-olds living in their parents' basement because housing inflation has priced them out of the market. I have single moms in my neighborhoods that can't afford a healthy basket of groceries to feed their kids. I have seniors whose savings are being vaporized by inflation. And now we have the prospect that deficits are going to drive up interest rates. So you can forgive me if my focus today is not on all the wonderful things the government's spending money on, but instead on where the money comes from. Because so far, all the money seems to be coming out of the pocket of working class folks
Point of
who
order,
are paying
Mr. Chair.
record inflation.
Mr. Polyev?
I have a strictly technical question. That is, where's the money coming from? $7 billion cost. The money must be coming from somewhere. Like, is there a money tree? Is there a printing press?
Point of order,
That's
Mr.
the
Chair.
technical question I'm asking. I appreciate that liberals
order,
across the
Mr.
way don't
Chair.
want it answered.
So if if you watch that video there from Pierre on that $7 billion budget, it kind of strikes you as like, it's true that nobody in government actually understands like where the money's coming from. Most people in government don't actually understand the financial system. They don't really understand financial markets. Like, that's just what it is. I mean, a lot of these people are career politicians. Maybe they're lawyers or what have you, right? They're civil servants. They don't understand markets. They don't understand, and most of them don't understand, again, how modern money creation is created. So if you're looking for the answer to that question, Pierre, is where's the $7 billion coming from? Quite simply, it's coming out of thin air. The government doesn't actually need to raise taxes to spend that $7 billion. Basically, what they do, again, to keep in mind, this is how the modern sort of financial banking system works. You can create money 2 ways. It's basically you can create it through commercial banks creating new loans, such as residential mortgages, or the federal government can spend it into existence. And so what they'll do in this case, for example, is they'll basically print $7 billion out. They'll basically issue debt, a bond, for example, and that bond is now being essentially purchased by the Bank of Canada, right? So as we've highlighted before, the Bank of Canada since 2019 has funded roughly 90%. They basically have purchased about roughly 90% of all government debt issuance. And so what happens is basically they'll spend the $7 billion, they'll issue a bond for that amount, the Bank of Canada will essentially buy it. Interest payments that the federal government makes on those payments, so they have to pay interest on that bond. They pay it to the Bank of Canada, which is actually a federally owned institution. It's a crown corporation, and so all those interest payments actually end up getting remitted back to the federal government. So essentially, all it is an accounting trick or swap. Now, again, to keep in mind, there's a couple technicalities to this. technically speaking, the Bank of Canada, they say they buy it in the secondary market, so they're basically competing, with banks or pension funds to buy this debt, and so they're not directly buying it off it, but essentially they are, because at the end of the day, the pension funds, for example, and the banks, and what have you, they understand that there's always another buyer, aka the Bank of Canada, that they can kind of sell to. It's almost like this greater fool sort of situation. So that's basically what happens, is this money gets created out of thin air, and that's really what we've been seeing and what we've been doing in this sort of QE era. And we know that this has been exacerbated throughout the pandemic, which is really why you're seeing asset inflation. That's kind of what I went on to the House of Commons there to sort of chat about, is, hey, listen, like, there are for every action that you take, there is a reaction, and by you guys spending during the pandemic, you obviously staved off Great Depression 2.0. For example, every dollar in lost income at the onset of the pandemic, the government actually transferred $3 to households. So for every lost dollar in income, $3 went to households, and that's why you didn't really have this, Great Depression. But what you did is you essentially armed households with, you boosted up their household savings, you supplied them with income supports, and you created an artificially low interest rate environment, which then allowed people to go and lever up, and through your actions, and the Bank of Canada's actions, you actually encourage commercial banks to lend money to, again, stave off sort of a recession or depression. And that's why we can see that residential mortgage credit growth is running at 10% on a year-over-year basis, which is the highest in 10 years. So that's where your inflation is. And speaking again of inflation, Canada is not alone. I mean, we just had the latest print out of the U.S. 6.8% CPI, 6.8%. I think the highest since the early 1980s. And what my buddy Luke Groman pointed out was, okay, so you've got you can factor in that the U.S. CPI print comes in at 6.8%. Again, however you want to define what's causing that inflation, the U.S. right now. So real rates, so basically the central bank's interest rate minus the rate of inflation means that real rates in the United States are currently running at negative 6.7%. Those are deep negative interest rates, which are, again, obviously beneficial for asset prices. If you're wondering why, we'll get into that in a sec. But so what Luke has pointed out, right? So the negative 6.7% negative interest rate has reduced U.S. debt to GDP ratio from 135% to 122%. So again, when you have real negative interest rates, it reduces, which is now creating inflation. It reduces the debt burden. Okay, so it's reducing your debt burden. You're creating the growth. You're paying back this debt in cheaper dollars. And so this is where we're talking about is financial repression, right? How do you bring down U.S. government debt to GDP, which sits at 135%? How do you bring it down? Well, you have basically interest rates that don't reflect the rate of inflation, and that's kind of what we've been talking about for many months in these videos. And Canada's no different, right? Currently, right now, the real rate of interest, we're looking at negative 4.5% in Canada. And when Canada's latest CPI print comes out, I suspect it'll be another increase for sure, and we'll have, again, deeper negative interest rates. And so this is something that actually that we've been highlighting here at the Real Vision Crypto Conference. Again, keep in mind that these are some of the most brilliant names. One of them was Dan Pantera. With Dan, I can't remember his last name. With Pantera, basically, he used to run a global macro fund. He actually switched into the digital asset space I believe in 2013 or 2014, very, very early into the game. But what he was highlighting was basically, per their research, you had this is the single largest devaluation of fiat currencies. And so you can look at it and say, okay, it's inflation 6% and maybe it's transitory, but all you have to do is really look at the asset values, right? I mean, one of the things that these guys pointed out, which obviously I've pointed out on the show before, but they were talking about the United States and the recent inflation print. They say, okay, well, listen, a lot of our homes this year in the U.S. are up, let's say 30%. He goes, is it not like, is your house 30% larger? Did you add on more beds or more bathrooms? Did your lot size get bigger? It's like, well, no, it didn't. It just the purchasing power, the value of the U.S. dollar just doesn't buy you what it used to anymore. So it's like your home is just going up in like nominal terms. It's not like, again, it hasn't gotten any better. And again, that's like so eloquent to hear in like Canada, right? I mean, like you see these like detached houses that are now, that have gone from say 1.2 12 months ago that are now selling for 1.6. Like, okay, it's up $400,000, but like, I mean, are you really better off at the end of the day? Arguably not. You have to kind of realize that gain or that profit. I mean, and I think what you're seeing now is people are kind of realizing that gain through home equity withdrawals and then funding that on secondary asset purchases, right? So the gap continues to grow ever wider for the asset holders. And that, again, was something that I pointed out to the House of Commons, right? I mean, at the end of the day, the people that benefit the most are the ones that are closest to the money printer, because you're basically allowing them to borrow at deep negative interest rates. And so long as you have a strong credit rating and assets, because banks do asset lending, right? So people always get confused. They go, okay, how are these foreigners coming in and buying, Vancouver and Toronto real estate? They got no income. It's like, okay, well, listen, first of all, in the banking system, there's what they call as a high net worth lending program. So long as you have, I think it's usually about $2 million in sort of in liquid sort of assets, that they will basically, they don't look at your income. They don't care. They're like, this guy's got $2 million in the bank. And the requirement is usually you have to put down 35% down payment on the property. So if you think, let's just think about it from the bank's perspective. $2 million in Buddy's bank account, he's putting down 35% on a hard asset. What's the risk here to the commercial bank? I mean, okay, like property values drop 35%. Okay, great, just take the house, done. There's not really any risk. So it's like these people just basically start to accumulate more assets, which only get inflated further from massive government spending deficits, obviously, and central bank money creation, etc. So anyways, that's sort of what I got. We'll probably, like I said, that I'll put up my sort of interview there in the House of Commons. Like I said, just thought it was kind of an interesting experience. Don't get me wrong here. I was like kind of laughing because it's like I'm in the real estate space. It's where I earn most of my income. It's where I have a lot of my assets. Here I am going on and telling the federal government that their massive deficit spending here is having side effects, which are boosting asset prices, which are ultimately helping me. And I'm telling you, you should probably kind of rein it in. But anyways, it's neither here nor there. At the end of the day, I have a strong passion for doing what is right for the Canadian people. And I think that we are in an era of massive wealth inequality, which is going to continue to grow and exacerbate because I think central banks are completely cornered. That's where we're at. So, as always, see you next week.